to retire at the age of 72 years old. So, so I decided I didn't want to work that long. And I began to look into real estate as a way to retire myself by the time I reached 50. And since I didn't have a real estate background other than owning my own home, I decided I would attend a free real estate seminar to get an idea of, how I could possibly make some money. Um, so I went to this free real estate seminar. The speaker opened up the seminar by saying, these are the top 10 ways people make money in real estate. And somewhere around number 6 or 7, he says, regular, ordinary people can buy the mortgage from the bank. And instead of the homeowner paying the bank every month for the next 20, 30 years, they would pay you.
Welcome to Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here is your host, Anette, Talie.
Welcome to another episode of Deal Closers. I am your host, Anette, Talie, and today is joining me Daphne Wilson. Welcome, Daphne.
Hi, Annette. Thank you for having me on the show. It's a pleasure to be here.
Yes, I am so very excited to have you. I heard you talk on a local meetup a couple of weeks, I want to say like a month ago. It's been a month already. And it was such an amazing topic. And I wanted you to come to my podcast and my show and share all that information with all my audience, because it was kind of new to me. Like I've had heard of it, but not really, I didn't have a lot of information. So this was a really good topic. So let me introduce you to Daphne. She's the president of Bell Financial LLC, founded in 2014 with the goal of capitalizing on the supply of mortgage notes in the interbank marketplace, with the primary objective to achieve double-digit high-yield investment returns while creating winning solutions for homeowners in distress. The business model is to purchase underperforming mortgage notes at a deep discount of face and market values and successfully renegotiate them to performing status, building a strong, secure portfolio with solid passive income flow. Wow, that's a lot of info. You're going to have to give me a lot of information on this, but welcome to the show.
Thank you. Thank you. Thank you very much. I absolutely love sharing what I consider to be the best kept secret in real estate. Back in 2013, I was 25 years into a career in computer science. And in spite of earning a great salary, I was basically on the fast track to retire at the age of 72 years old. So I decided I didn't want to work that long, and I began to look into real estate as a way to retire myself by the time I reached 50. And since I didn't have a real estate background other than owning my own home, I decided I would attend a free real estate seminar to get an idea of, how I could possibly make some money. So I went to this free real estate seminar. The speaker opened up the seminar by saying, these are the top 10 ways people make money in real estate. And somewhere around number 6 or 7, he says, regular, ordinary people can buy the mortgage from the bank. And instead of the homeowner paying the bank every month for the next 20, 30 years, they would pay you. And I thought, you've got to be kidding. That sounds like it's for me. So I was so excited about it. I asked him, I said, at the break, I walk up, I said, when are you going to talk more about this mortgage note thing? And he says, this isn't the seminar for that. We're going to talk about wholesaling and fixing and flipping and rental properties. So I said, well, that's okay. So I left. I didn't even stay for the rest of it. I just went home and Googled and learned as much as I could. And the more I read about it, the more I liked it. So, fast forward 6 years later, here I am. And what I do is very simple. I buy mortgages from banks and hedge funds, and people pay their mortgage on their house every month, and that payment goes into my checking account.
That's awesome.
The Deal.
So that's a lot of information that I want to unpack for people to understand how the process works. This is going to be a little bit of a different, show, because I want to learn. I want you to share with everybody the process of how do you get the bank notes, how do you buy them, how does this process work? Because I don't think a lot of people are familiar with it. I wasn't that familiar with it. So please share with us how do you start?
Well, basically, um, what I do is banks and hedge funds and investors and credit unions, they let you know what loans they have available for sale. And so you really simply determine what your investment criteria is. And so you look for loans that meet that criteria. So to give you an example, um, I purchase second mortgages. And I like second mortgages because one, they're less expensive than buying the $400,000-$500,000 mortgage, because they're maybe the $20,000, $30,000, $60,000 mortgage. So they're less expensive. And also the homes tend to be nicer because people tend to take out a second mortgage to redo the kitchens, baths, maybe put a pool in the back or something like that. So the price point is low. Additionally, I make the most amount of money. I get the highest rate of return when I buy a mortgage loan that is delinquent, because it's the least expensive loan that you can possibly buy, but it's also still very much secured by the real estate property. So my goal is to purchase a delinquent second mortgage on the borrower's primary residence where the first mortgage has never been late. It's never been late. And that lets me know that the homeowner is interested in staying in the property because they're keeping up with that first mortgage. So that is really kind of my niche in this particular market.
So you buy a second mortgage of a person on a primary home that is delinquent only on the second mortgage, but never on the first mortgage.
Correct.
And that they live in the house because you want them, you know that they want to stay there.
Yes. Yes. That's
Excellent.
home for them. Mm-hmm.
Excellent. All right. So how do you find these deals?
Well, their loans can be found in many different places. Banks, hedge fund managers, credit unions. You can also find, there are also note brokers. There are individuals that put note buyers together with note sellers. Also real estate attorneys, asset managers. There are mortgage loan exchanges, which are online portals. So they're pretty much everywhere. I've even seen mortgage notes for sale on Craigslist, believe it or not.
Oh, wow.
Pretty funny. But the thing is, the due diligence, the research is the same no matter where you find the mortgage note. So,
right.
But they're out there, and there are various ways of finding them.
All right. So once you found it, like, how do you do all this research on the note to see if it's a good or a bad investment?
Oh, lots of the information is available before you even put in an offer to purchase a loan. So you're going to look at a lot of public record data. There's some research that you can do on the borrower. There's credit report information, lots of different public data that's out there and available on the property itself, on the homeowner, as well as on the actual mortgage note itself.
Right.
So
So
all of these resources is what you use as part of your due diligence.
when you're looking at the owners, at their credit report, what are you looking for?
I'm really looking for how they're using their credit, what they're doing with their other trade lines. So if the loan that I'm purchasing is really the only thing that's delinquent, and I see that they're keeping up the payments on everything else, then that gives me an indication that they are more likely willing and able to start paying on the second mortgage. So I'm not so concerned with the credit score because, you know, bad things happen to good people. And so you know, some families will go through a period of time where things are kind of difficult. But if I look at their credit report and I see that they're kind of trying to pull out of that and they're trying to rebuild their credit, those are the types of things that I'm looking for.
And when you see, what's the thing that you see on the report and you're like, no, this is not a good idea?
If I see that the first mortgage, the senior lien, is either delinquent or it's being paid slowly, meaning that the homeowner will maybe pay a month and then skip 2 or 3 months and catch back up. That sort of thing is what I'm looking for in terms of a red flag.
Mm-hmm. What about like medical bills?
Medical bills is probably one of the number one reasons people get behind in paying a second mortgage or even a car note or other things. When I see medical bills on there, it lets me know, okay, something happened. Maybe this person was hospitalized. Maybe they had to. Maybe they lost income as a result, and that is what caused them to become behind. And so I'm going to look at when that occurred, and you know, just kind of what's happened since then to help me determine, you know, whether or not I feel that this person has the ability to start repaying the second mortgage. But it's really an indicator. I'm looking for clues to see, you know, maybe what has happened to cause the homeowner to come behind, become, you know, delinquent in that loan, and determine whether or not they're in a better space now.
Okay, so it could go either way, really, right? It could
Yes.
be a good thing, but it could be a bad thing if they are still during that period where they cannot pay.
Yes. Yeah. And another thing I'm looking at also is the homeowner's debt load. I do not know their income at this point, but what I can see is how much they owe. And so another thing that I'm trying to assess is the likelihood that they may file bankruptcy. Because, you know, that would be a possibility, particularly if a person has never filed, they have a huge amount of debt, and it's obvious that they're struggling. Then, you know, one thing that could possibly happen is, you know, once they get notification from me that I intend to collect on the debt, then that may trigger the knee-jerk response of filing bankruptcy. So that's another thing that I'm trying to assess when I'm looking at the credit report.
So do you look at a percentage that they have in debt, or how do you gauge what's reasonable and what's risky to you to file bankruptcy, for them to file bankruptcy?
Yeah, it's one of those things that's very much, it's up to kind of the individual investor. You know, I'm looking at the value of the home, looking at, you know, what other assets that they may have, you know, how many cars, things like that that are on there. And, you know, I am comfortable with probably about $20,000 in debt or less. You know, if I really start seeing, you know, 80, 100, $150,000 in consumer debt, that makes me kind of nervous, you know, because that's a good enough reason for anybody to say, you know what, I just need a fresh start. And bankruptcy will give me that fresh start. And, you know, they may attempt to offload that debt. Now, that may not be very much of a concern if there is considerable equity in the property. because if there's equity in the property, then it really it doesn't matter as much if the homeowner files bankruptcy, particularly Chapter 13 bankruptcy, because if the home is in a positive equity position, there's enough of an equity buffer above that first mortgage, then the second lien will be secured. It'll remain secured on the property.
Okay, so it's not as risky if the property has a lot of equity on it.
Right.
But what about if it doesn't have any equity? Do you lose the note?
If it doesn't have equity and the house and the homeowner owes more on the house than what it's worth, if they file Chapter 13, then the judge could strip the second mortgage off the house and basically say that it's unsecured. And in which case, the debt becomes very similar to like credit card debt. It's unsecured debt, and it takes the lien off the property. That's if the bankruptcy, the Chapter 13 plan is actually completed. Usually it's a 5-year plan. And if the homeowner keeps up with it and continues to make their payments throughout the entire 5 years, then the loan would be stripped off the property. Now, a lot of homeowners, more than 50%, do not complete the 5-year bankruptcy plan. In which case, if they don't, then the lien remains intact and the holder of the second mortgage can continue to pursue payment.
What if they do a Chapter 7?
A Chapter 7 will basically, the homeowner would no longer be personally liable for the debt, but there still remains a lien on the property.
So they cannot sell it?
They don't, right. They could not sell it. And if they don't pay it, the holder of the second can still foreclose on that property. So essentially they would get their money out of the property and not from the homeowner.
Okay, so Chapter 13 is the one you gotta worry about.
Yes.
So
yes.
Then it becomes a little bit of a waiting game, right? Because then they have 5 years to complete this plan. And if they don't, then you're still on second position.
Yeah, you basically just hold on to it. You check with the bankruptcy court every, 2 or 3 months or however often you want to check it to see if the homeowner is still participating in the bankruptcy plan. And, you just kind of put the loan on the back burner until, you see whether or not that's going to complete. But there's another exit strategy too, because there are investors, believe it or not, that purchase those loans. And they purchase them super cheap, basically because an investor that owns a Chapter 13 loan, they may feel like, well, rather than having my money tied up, I'll sell this loan and, and just exit out of it that way.
Right.
So that happens.
But you can avoid all this by doing your research, engaging which loans do you want to buy.
Absolutely. Absolutely. This is a space where you can really assess your risk up front. If you're looking at a mortgage note to purchase, you can see right away whether there's equity above the first mortgage, how much equity there is, and if you feel that it's enough to protect your note investment. You can find that out up front before you even buy the mortgage.
Awesome. All right. So now you found these mortgages, you research and you like the deal. And so what's next?
What's next is very simple. I will purchase a mortgage loan. Once I purchase it, the previous lender will FedEx overnight the collateral to me. They also have to send out a letter to the homeowner, letting the homeowner know that their loan has been transferred to another lender. And 30 days after that, I send out a letter to the homeowner introducing myself as the new lender, my company, and providing all the pertinent information. and you know, start communicating with the borrower, finding out basically what their intent is, what they would like to see happen with the loan, and start moving towards a resolution to, you know, get them either back on track with the mortgage, or, you know, if there's another alternative.
All right. So can we talk numbers? Because you gave an awesome example when you did your presentation at the meetup. So let's talk about numbers. Give us an example of how much you bought it for, what was the debt, and all this once it's all put together.
Okay, great. Let's see, the art of the deal. So I purchased a second mortgage on a house in Grand Rapids, Michigan. I paid $2,700 for it. Okay, $2,700. The remaining balance on the mortgage that the homeowner owed was $27,879. That's what was left for them to pay. This particular homeowner was 4 years behind in their payments, but he was current on the first mortgage. Okay.
Mm-hmm.
Now, since he was 4 years behind, it would have cost him about $15,000 to bring this loan current with the previous lender. Okay.
Because of all the interest and late fees.
Yes, interest, unpaid interest, late fees, back payments, all of that would have cost him 15 grand to reinstate it. I allowed him to reinstate the loan for $7,000. Okay, he was very happy with that. Much easier to come up with 7,000 than 15.
And this 7,000, are they supposed to pay to you cash, or do you divide it on the loan?
It's paid up, it's paid in cash. Mm-hmm. It's wire transferred. Mm-hmm. Directly into my business checking account.
Okay.
So that $7,000 more than doubled, almost tripled what I paid for the loan, which was great. So I got my money back plus some upfront. Then what I did was I worked out a loan modification with him. This homeowner could afford to pay $385 per month. So I began to collect $385 a month from him for the next 15 years. So this loan is spread out over 15 years on the remaining balance, which in this case was $35,879, because I took that other $8 grand and I put it on the back end of the loan.
Okay. Oh, okay. That's so you didn't even lose that. So you just offer
that.
him to just reinstate it for almost half, a little bit less than half, and then the other money you put it on the back end.
Yes, that's right.
How did you define the 15 years?
Well, I was trying to get to a payment that was affordable for him. So he didn't want to go over $400. I looked at his financials, and you know, I thought, okay, this is good. This is comfortable for him, and it met my expectations in terms of what I was looking for as a return. So that's how we came up with it.
Awesome.
But it gets even better, right? So I collect these payments, this $385 a month, from the homeowner for 12 months. Okay, this money is taken out of his checking account via ACH transfer every month on the same date, whatever date he chose. Okay, so I collect 12 months of payments, and then I decide that I'm going to sell that loan to an investor. Now, because the loan has a solid payment history of 12 months, I sold that loan for $28,000.
Wow.
Okay, so here's the math. I paid $2,700 for the loan. I got $7 grand up front from the homeowner to reinstate it. Then I collected 12 monthly payments, which totaled $4,620. And then I sold the loan for $28,000. So the total I collected was $39,620 on a $2,700 investment. Yes.
That blows my mind. That is
Yes.
amazing return. That is
Yeah.
an amazing return.
Just a little, a little bit of money up front, a little bit of time up front. This deal was financed using my own funds. It was only $2,700. So when I first started in the note business, I didn't take out a loan. I leveraged my income from my regular job to buy my first mortgage notes with. And it was very affordable. Most of the assets in this particular asset class range from about $2,000 to $10,000 per asset. There's some that are more, at the high end, I think I've spent about $17,000 for a loan. On the low end, I've paid as little as $800 for a mortgage. But most are in that $2,000 to $10,000 price range. Takes a little bit of time up front. It's about 4 to 5 hours a month per asset.
Right.
So one loan, 5 hours total on that particular asset that you're spending on it. So there's a little work up front, but then it's passive the rest of the time.
Right. And so how many loans did you buy before you left your job? Because when you started, you said that you were working still at your regular job.
Yes. A couple of things happened. For one, I kind of sat down and figured out what my expenses were. What did I actually need to survive in terms of housing expenses, electricity, gas, grocery, things like that. And then I took that number and I said, well, if I could get each homeowner to pay, say, $300 a month, how many $300 a month payments would I need in order to meet my expenses? And that's kind of how I backed into it, and that's what I suggest, for new investors to just kind of back into it. If they're looking at notes as a way to retire themselves or replace a job, to kind of back into it that way. Now, I did meet myself halfway, meaning that at the time I got started in note business or was looking at it, I had a big home, I had a couple of cars, I had, my overhead was really way up there. But then my daughters, they were adults, so they were, grown, gone, off the payroll. And so what I decided to do was, I said, I don't need all of this house and I don't need all of these cars and all of this. So I actually really scaled down and kind of right-sized my life. And that helped even more to make retirement much more accessible to me.
Absolutely.
Yeah.
That was so smart, because then now you have all this extra income that you could invest quickly instead of having to wait to save it, to invest more.
Exactly. Yes.
That's awesome.
Yeah.
All right. So that was so smart. So you worked the number back. So you said, okay, this is my budget. This is the amount of money that I need monthly. And then I need this many notes in order to support my expenses. And then you were able to leave your job. And how long did it take you since you made this plan until you were able to do it?
It actually took me 2 years. I could have retired earlier, but at first I was thinking, oh, this is great because I could still work and be making this extra money. And then I think what happened was I had 2 loans that I bought, and the homeowners decided they didn't want to pay a second mortgage anymore. So they refinanced and I got paid off. So I got 2 lump sum payments. I think one was like $80,000. The other one was like 40-something thousand dollars. And I was just like, I'm done. I'm done, because it immediately refueled my capital. And, from there, I could buy pools of loans. So instead of just buying 1 or 2, mortgage notes, I could buy, a group of 5 or a group of, 8. And, so that really kind of accelerated, the growth
The
of
growth.
my portfolio. Yeah.
Amazing. Wow, that's incredible.
Hmm.
So
Yeah.
this is,
And I
it's
was
blowing my
one thing
mind.
that,
We're gonna have to talk after this, because I was blown away at the meetup, and I was like, oh, I should like start doing that, and now I'm like, again, I'm so excited about this.
yes. And, I think that probably the thing that really excited me the most was that, mortgage investing is location independent. So you can purchase mortgage notes nationwide, or no matter where you live. I own mortgage notes in multiple states. You never visit the property. The bank never has to go to the property. um, and it's great because you can do this anywhere.
Right.
You don't have to be physically in a particular place like you normally would with more traditional real estate.
Right. And how can people learn about this?
Oh, people can learn about nodes by educating themselves. The great thing is that there's no, what should I say, there's no certifications or exams or anything like that. You really just need to know what to do. So for anyone that is interested in learning how to invest in mortgage notes and adding notes to your real estate portfolio, I invite you to visit my website, which is mortgagenoteinvesting.info. And I offer a comprehensive workshop that will teach you step by step, from beginning to end, how to invest in mortgage notes, including resources on where to find notes. It really is truly a workshop because during the course of this workshop, we're looking at live notes that are available for sale on the open market. And I'm actually teaching how to do your research step by step, how to interact with the homeowner, how to do a loan modification, what they look like, the rules and regulations in various states. So we cover all of that there. And the best part about it is that it includes mentorship. So I personally mentor my students, which are all over the country. And we work together on their deals. So it includes unlimited mentorship by myself. So that's how they would learn.
That
And
is awesome. And this is like a lot of people are always asking, how can I get into investing? And besides everybody recommends wholesaling, but this is another way in which new people can get into the game. They can start with a very low, you said that you could buy some for $800. You can save money for a couple of months, get $1,000 and start buying your first note and get into the game. And once you get a cash flow, then you can start getting into other types of investing.
absolutely, absolutely. And I always tell people, even if you just buy 1 or 2 notes, you could easily cash flow an extra $500-600 a month. And an extra $500-600 a month will start paying down a student loan bill, because that mortgage is going to pay for the next 15-20 years or more. So that's money that's being paid towards debt or towards anything else, that doesn't have to come out of your own pocket. So yeah, it definitely will pay for itself.
Awesome. That is awesome. So
Expert tips.
now is the time of the show where you're going to give me 3 tips, and Daphne is going to give us 3 tips on mortgage investing.
Yes. So tip number 1, be very clear about your investment criteria. There are a lot of mortgage notes available on the open market. For every property in America, most of them have a mortgage. Okay. And many of them have more than one. So there's no shortage of mortgage notes out there to buy. And so you want to be very clear about your investment criteria. Do you want to buy first mortgages, second mortgages? Can the home be rented or vacant, or should it be occupied by the homeowner? What state or city should it be in? So there's lots of different criteria. So you want to be clear about that up front. The second tip is I would suggest focusing on 2 to 3 states in which to purchase your assets. Instead of, just kind of saying, oh, wherever it is, I'm going to buy it. It's great to pick 2 or 3 states that you kind of want to focus on. And that way you can build your resources in those particular states.
Is there different rules for collecting also? Like if you do, only 3 places, then you only have to learn the rules for these 3 places instead of like 12?
Yeah, that's it. That is a great example. Absolutely. The rules and regulations and even the foreclosure guidelines work differently in different states. And so, you want to, the more experience you have doing business in a particular state, you become very familiar and you know the do's and don'ts, and it really makes your process is a lot more streamlined. So one of the key things is that you don't want to have to reinvent the wheel every time you buy a mortgage note. You want to have processes set up for yourself so that it's easy to, execute according to your business model.
Awesome.
Mm-hmm.
All right. What's
And
the third tip?
Third tip is to define your business model before you purchase. So we talk about 3 business models in the workshop. And the first business model is a buy and hold. That's where you buy the mortgage note, you do a loan modification with the homeowner, and then you just cash flow the payments until, for the next 15, 20 years until the loan is paid off. But then another business model is to flip the note, which is what I did in this case with the deal that we just talked about, is I'll buy the note, I'll work out a payment with the homeowner, and then 12 months later, I sell that note for a profit. And then a third business model, some people actually use mortgage notes as a backdoor way of acquiring property. So if you're looking at notes to create inventory or to amass inventory, to do fix and flips or to acquire rental property, then you purchase the loan for little or nothing. A person is not interested in keeping the property. So you either do a deed in lieu, cash for keys, or, if they're uncooperative, then you could foreclose on the property. And then you basically take the property for what you paid for the note. So those are 3 different business models. And there's more than that, but those are kind of 3 basic ones. But you want to define what your business model is before you start investing in notes.
Right. So on that third example, you wanna, if your purpose is to keep the property, then you're gonna have a different criteria than what you were looking at, right? You're gonna be looking at people that can't pay it anymore, and that you are gonna end up with a property instead.
Exactly.
Okay, so you have to define your criteria and define your business model, so then you can look for these properties that fit your criteria and your model.
Yes.
Awesome.
Yeah.
All right. That was amazing, Daphne. Thank you so much for joining my show today. And I think you provided amazing value. And, people, if you are interested in getting into real estate with small cash, because you always need some money to start in real estate. I don't think it's very hard to start in real estate with no money down. There's some ways, but this is an option that is very low money down, and then it can lead you to other deals later. So thank you so much. This was a pleasure.
Oh, you're welcome. You're very welcome. And just a couple things I wanted to add. Notes are a very, very liquid asset. Notes can be purchased in 1 or 2 weeks. It can also be sold in 1 or 2 weeks. So your money isn't tied up when you buy mortgage notes. And then the final thing I wanted to add was, if anyone is interested in learning how to invest in mortgage notes and they're interested in taking my workshop, again, just visit mortgagenoteinvesting.info. And if you sign up by the end of the week, you can take advantage of a 25% discount by using the discount code Deal Closers.
Awesome. That is amazing,
So,
Daphne. Thank you so much. So
yeah.
people, take advantage of this 25%. I'm going to take advantage of it. And, if you're interested in doing this, your course is probably teach you from A to C, and then you don't have to go anywhere and keep researching. So that would
That's
be
right.
amazing.
Yeah.
All
Yeah.
right.
Thank you
Thank you so
so
much.
much. Yes.
Bye-bye.
It's been a pleasure. Bye now.
This was Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.